Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about people that have a defined benefit plan. Does it still make sense to build up an RRSP portfolio? Do you run into tax issues? So we're going to walk through that and just go through real life examples that we see firsthand in the office. We come across defined benefit plans more often than I expect. A lot of you have them that reach out to us, and a lot of you have two of them or three of them sometimes. So let's break down, does it make sense to still build up an RRSP? Does it create a tax issue at retirement? And how do we kind of plan forward for retirement to make sure that we don't run into that? So this question came to us in a comment in one of our videos from Nona's Stitching Lounge. So I'm just going to read it to you, and then we'll break it down a bit here. So I have a defined benefit pension. My husband doesn't. Could you do a video on the nuances of retiring with a defined benefit plan? I know the benefits, but is there value to RRSPs before retiring? What about splitting the pension? So great question, Nona. So let's break this down. So in this case, Nona has a defined benefit plan. Her husband does not. Okay. So again, we don't have all the facts here, but let's say they both make $60,000 a year for simple math. Okay. So Nona's building up her pension plan. Okay. Again, let's assume her pension plan is going to pay her out $45,000 in retirement. Okay. The benefit is for her husband to build up an RRSP is for the tax savings. Okay, whether he's at 60 or 80, anything above that 50,000 mark, we usually would recommend start contributing to an RRSP and get the tax break. Okay, now things to keep in mind with your defined benefit plan. When you start taking out money from your defined benefit plan, it's pensionable income and you are able to split it. So Nona, I know you asked, can you split that income? Yes, you can. Your pension income, you can split at any age. So you can start splitting that a bit earlier than, say, an RRSP. Okay, with an RRSP, as you build it up, when you hit retirement, you can only split any RRIF income with your spouse once you hit 65. Okay, so once you hit 65, you can convert some or all of your RRSP to a RRIF. You can start taking it out, and you're able to split that income with your spouse or common law partner. But before 65, RRSP money cannot be split if you're taking it out. So keep that in mind. So pension you can split, your RRSP you can't. But is there a benefit to build up an RRSP heading into retirement? Well, there's a few factors here. Okay, factor number one is how much is your pension plan? Okay, so we ran a scenario the other day. Someone had a pension plan that was paying them $90,000 a year, indexed. Okay, that's a massive pension. We don't usually see them that high, but if your pension's $90,000, you add on your CPP, your spouse's CPP, two OASs, you're at a fairly high family income. Not OAS clawback territory, but you're quite high and probably enough income to live off through retirement. So you then have to take a step back and say, okay, well, in this case, the husband, does he have a high income? Does he need the tax write-offs, leading up to retirement? If the case is yes, it's still worth it to put money into his RRSP, build that up and get a bit of a tax break. But you do want to start focusing on some TFSA money as well. The benefit with a tax-free savings account heading into retirement is you can pull that money out tax-free. Okay, so if you have a pension, let's say of $90,000 plus your OAS plus your CPP, when you need extra money, an injection of money, you want to make sure that you have a bucket that you can pull out of on a tax-free basis, or else you're just driving up your taxable income, which could result in old age security clawback. So keep that in mind. Now, for most of you, if you have a defined benefit plan, it's probably sitting in that $40,000 to $60,000 a year income range. Okay. Now, if we took, say, $60,000 a year, your pension is added on your CPP OAS for you and your spouse if you're married, in the situation known as married. Your income probably is going to meet your income needs in retirement. So you're not building up an RRSP necessarily for retirement income per se. You're using the RRSP for a tax break leading into retirement. Okay. So Nona, if your husband is falling into a 30 or 40% or higher tax bracket, it will make sense for him to start putting money into an RRSP to start getting that tax refund. So my recommendation, if you can throw $10,000 a year into his RRSP at a 40% tax bracket, you're going to get back $4,000 and put that $4,000 into a tax-free savings account. Okay, you're compounding your money, it's working for you, and you're building up two nice accounts for retirement. Okay, in retirement, you and your husband, again, I don't know what all the numbers are with you guys, but most of our clients fall between about 16 and 22% average tax rate in retirement. Okay, so let's say it's 20%. Your husband's been able to put money into his RRSP at 40%. And when we take it out in retirement, he's going to average out at 20%. Okay, so that's a nice spread. Okay, getting the 40% tax break, letting it grow tax deferred, pulling it out at 20%. Plus, again, putting the money in now gives them a nice tax refund that you can then shuffle off to a tax-free savings account and start building up that account. We actually did 2 plans this past week for clients that had 2 pension plans. Okay, husband and wife both had great federal government pension plans, paid a good amount of income, and they also had a fair amount of RSPs, TFSA non-registered, other investments saved up, and a large portion, both of them were over $500,000 of RRSP money. Okay, both pensions, one was $40,000, one was $60,000. So let's say $100,000 of pension money plus CPP plus OAS plus $500,000 bucket of RRSP money. And we were able to strategize so there was no OAS clawback. They had a nice income. So, if you're in a high income bracket, yes, it still makes sense to build up that RRSP leading up to retirement. There's tax planning strategies. It may mean you get to retire a bit earlier as well. Okay. So, if you've built up 2 pension plans and an RRSP, it might mean 2 or 3 years earlier retirement for you. Okay. Spread out that tax bill. So make sure if you have pensions, some RSPs, you're building up those assets, make sure that, a couple years before you think you can retire, sit down with a financial planner, break down those numbers. A lot of people that we do plans for, and it's actually quite shocking. So Matt and I, my paraplanner in the office, and we talk about this often. We'll put a plan together for someone. They've sent us all the information. They think they can retire in 2 years. They're not sure. They're, uncertain about it. And we run the numbers and they could retire today. And it happens more than it should and more than we thought it would ever happen. So, make sure that you actually map out, because you may hate your job and you may not need to work the next year, 2 or 3. You may be able to retire now, and that could be an option for a lot of you. So just make sure you have a plan. But again, if you have a defined benefit pension plan, building up an RSP will help. A lot of you say, I don't want the RSP. We run into tax issues. Look, we've had clients that have 2 great defined benefit pension plans and a substantial RSP, and we're able to still do proper tax planning, not run into OAS clawback coming into retirement. So, it never hurts to have more money. You can always kind of map it out, plan it out, strategize it so that it works in your favor. Another option for you, and we're running through this with a client right now, is if you have 2 defined benefit plans. Now, I know, Nona, you don't, you have 1. But let's say you're watching this video and you and your spouse or common law partner each have a defined benefit plan. One option you can look at is, are you able to take the commuted value out of your pension plan? So, the one we're working through right now is we're looking at the lower pension earner will actually potentially take out the commuted value. So you have 1 defined benefit plan. The other one, you're rolling some into a locked-in registered account and getting some cash out. So there's some strategies there you can use, to map that out, see if it makes more sense on an income and tax-wise, creates more flexibility. So again, if you have 2, look at, can you take the commuted value on one of those pensions, and does it make sense long-term? One thing to keep in mind when you look at your defined benefit pension plan, a lot of them will carry, healthcare insurance, life insurance with you through retirement. Okay, so before you take out a commuted value out of your defined benefit plan, make sure you understand the ramifications of it. Okay, the one that we're working through with a client right now, they work at the same place. Okay, so if one of them takes commuted value, the healthcare still follows with both of them. They're not losing any value there, the way that their healthcare setup is moving forward into retirement. But make sure, like, if you take the commuted value and you're the only pension earner, you may be losing healthcare, which could be a big cost. You have to weigh that out. Again, we've taken commuted value for clients where they lose the healthcare, it still makes sense financially. Some we haven't. So every situation is different. So just make sure you map through your situation to see what makes the most sense for you. So Nona, hopefully we answered your question. If your husband is in a 30, 40 or higher % tax bracket, start putting money or keep putting money into his RSP, build that RSP account up. It'll complement your pension well. If you retire before 65, you can start taking your pension out. You can split that with your husband. If you're worried about split income, if you're, I don't know how old you are, but if you're retiring earlier, let's say 55 to 60, and you have your pension income, which you can split, keep in mind how you structure that other account. Maybe your husband, if he's building up a big RSP, he does some spousal RSP to actually allocate some to you as well. So there's kind of some fine tuning that you can do there. But in general, if he's in a higher tax bracket, keep putting money into that RSP, because he's going to be able to get a nice tax break now and get it back out in a lower tax bracket in retirement. So thanks for joining us in this video. Hopefully it helped out. Again, remember, pension income, your defined benefit pension plan, you're able to split with your common law or spouse before 65. RRSP money, You can roll it to a RRIF at 65, all or some of your RRIF account, and start splitting that income with your spouse or common law partner. So you have to wait on that RRSP. So for those of you watching this video that don't have a defined benefit plan, if you're planning to retire before 65 and you're married or common law, make sure that you're building up, somewhat equal accounts leading up to retirement. It's not super important, but you'll make sure there's enough, say, spousal RRSP if you have one high income earner, that those first few years leading up to retirement, there's enough spousal RRSP that you can pull out to kind of weigh out and even out the tax bill.